This episode is sponsored by FM Investments. Investors concerned about inflation should take a look at an ETF called RBIL. RBIL is an ETF that harnesses the inflation protecting power of TIPS. Those are Treasury inflation protected securities. They're issued by the U.S. Treasury, the full faith and credit of the U.S. government. And the principal and coupon of TIPS adjust daily based on changes in the CPI. RBIL makes investing in TIPS as easy as buying an ETF. Check it out today for potential yield and as a hedge against inflation. You can find the link in the show notes or go to USTreasuryETF.com/ETF/RBIL. Hi, everyone. It's me, Downtown Josh Brown, and welcome back to What Did We Learn? As usual, I'm here with my friends Nick Colas and Jessica Rabe. Nick and Jessica are the co-founders of DataTrek Research and the authors of DataTrek's morning briefing newsletter, which goes out daily to over 1,000 institutional and retail investors. They're also two of the smartest people I know. Nick and Jessica have their own YouTube channel, which you can find a link to in the description below. Nick, Jessica, welcome back. How are you?
Good. Thank you.
Doing well. Jessica, let me hear you.
Very well, thank you. Thanks for having us back.
All right, guys. We, for those of you in the audience, we had slight technical difficulty, but I think we have it. We have it all in hand now. Jessica, you asked a question, and it seems rhetorical. What year is it? So I think it's 2025. But what's on your mind right now?
Yeah, I have two historical comparisons for the S&P 500 and NASDAQ that we think provide useful roadmaps for the rest of this year. So I thought we'd start on somewhat of a cautious note for the S&P because since 1980, there's only been 2 years when it peaked in February, and that's 1994 and this year to date. And we have a table we've actually shown you before with the number of times the S&P has reached its high for the year in each month back to 1980, along with the average annual returns for each scenario. And as you can see in the chart, it's very rare for the S&P to peak early in the year, but when it does, calendar year returns are disappointing. And that's because stocks usually rally through the entire year during bull markets, and we've had 5 of those since 1980. In 1994, the S&P posted a 1.3% total return, which, while not terrible, is still well below the usual average of 10 to 11%. And aside from 1994's February high, that year was also similar to now because there was a large negative macro surprise back then that's pretty comparable to now. So in February 94, the Fed started an aggressive tightening cycle that no one expected. And things were really different back then because Fed communications, they only came really twice a year when the chair briefed Congress. And on top of that, Fed Chair Alan Greenspan was famously and purposely vague about his views. So the bottom line here is that the 1994 rate cycle was a huge source of investor uncertainty all year. And this year, of course, there's been an economic shock with markets caught off guard by Trump's aggressive trade policy, which was also a genuine surprise to markets. So we have a chart that compares index daily returns for the S&P in 1994, and you can see it in the blue line, and 2025 year to date in orange. And I have 3 quick points here. The first is that, as you can see in the chart, this year's trade and tariff policy shock caused a much deeper pullback than 1994's Fed policy shock. But stocks have also rebounded much quicker, and that's because the administration quickly changed policy by laying tariffs by 90 days because of all the market volatility its initial moves caused. And second, 1994 is a cautionary tale about how ongoing policy shocks throughout the year can kill rebounds and keep stocks under pressure. And you could see that the S&P had a lot of fits and starts as the market dealt with a whole series of rate hikes throughout 1994 and with little guidance from the Fed about when they end. All in all, the FOMC raised rates by a total of 250 basis points that year, including a rare and large 75 basis points that November. And then third, so far the U.S. equity market is saying that this year isn't necessarily like 1994 with its long series of unpredictable policy disruptions. Fortunately, the S&P has bounced back and it's now up on the year, thanks almost entirely to hopes for more reasonable U.S. trade policy. So just summing up this first comparison, the lesson from our 1994 playbook is that trade negotiations need to go smoothly in order for U.S. equities to rally from here. And so far, so good on that front, but the year, of course, isn't even halfway over.
The initial rate hikes that Greenspan did in 1994 were such a surprise, not just because they were aggressive, but they happened off schedule, I think, or some of them did. Nick, do you remember any of that firsthand?
Sure, I was there. I remember it vividly. They were all at regularly scheduled meetings, but February was the first time ever the Fed put out a press release the day of a meeting. First time ever saying, "Oh, we're raising rates." I remember that day vividly, and it was like, "What the hell's going on? Why is the Fed telling us about this rate hike?" And so it was a series of shocks, but on a regularly scheduled basis, if you will, but still quite alarming because we just didn't know how high they were going to go.
Why did they do that? They were worried about it. They were worried about inflation starting to appear, or had it already appeared?
It had started to appear, and the economy was really chugging along. And the Fed's actually done a lot of forensic analysis on what went wrong in 94. They've written whole papers about it. And they recognized that they just didn't warn the market enough because of this very intermittent communication policy that Jessica outlined, twice a year, basically. But they did it because they were worried about inflation and worried the economy was really beginning to overheat after the recession in 1990 due to Gulf War I and the very slow recovery from the 91 recession that finally really gained steam in 93.
It doesn't appear that pullback for the S&P was terribly significant, at least given what we've all lived through in the last 5 years. But at the time, it was unnerving because there probably aren't a ton of examples post-Volcker of a Fed chair knocking the market around to that extent. I think the people who had been trading in 1994 who lived through the early 80s, they probably said, "You ain't seen nothing," compared to what the Fed chair used to do to the stock market. But I think it almost seems quaint at this point to look at 1994 as though it were some watershed moment for the market, because it just doesn't appear to be that big of a market disruption, at least compared to the tariff thing this spring.
It was if you lived through it, because the rotation, cyclicals had been the winners from 91 to 94. I was an auto analyst, and I was like literally the rock star analyst of First Boston. I was covering all the hot stocks. I was the tech analyst of the day. And then when the Fed started to raise rates, the lights went out. Cyclicals stopped working. And if you want to pinpoint the beginning of the 95 tech bubble, which Jessica will discuss in a second, it was because of this rotation in 94, because investors started saying, "Oh, if the Fed's raising rates, I need to go to growth stories." And that laid the groundwork for the entire 95 to 2000 tech boom, which Jessica can discuss now.
So you think that set us up for what came in the second half of the decade? It was
absolutely the setup. Until 94, cyclicals were the only place to be. There was an old joke about tech analysts. How do you get a tech analyst out of a tree? Cut the rope. That was how bad the tech sector was in the early 90s.
Oh my God.
Jessica, can you top that?
No.
All right. What was the other point that we wanted to make before I attempt to make a point? But the similarity to 94 was this disruptive moment in the spring, and the market pullback that we eventually recover from. That year ended plus 1%. Where are we now, year to date on the S&P? Is that about where we stand today?
We're up 2%.
Up 2. Okay. All right. Any other lessons from that time that are worth getting into?
I think it's just how important policy is, and that can trump fundamentals, because when you have a policy shift like in 1994 and this year, you get worried about recession. You worry that corporate earnings can fall as much as 25%. So that's why you have such a strong reaction in the markets when there's a positive or when there's a negative policy shift, but then also when there's a positive policy shift.
So I want to throw something at you guys. One of the conversations that I think has been going on for years now, but has sort of intensified in the wake of the market recovery, is that companies are just better at being companies. They seem to be more resilient. The people who manage them seem to be way better at their jobs on average than perhaps the people who managed corporations in, for example, 1994. And the analogy that I try to draw for people, I guess because it's NBA Finals time right now, but I think like most people would say there were amazing basketball players in the 90s, of course. But I also think most people would say on average, the NBA player, not star, but player today is a better player than the average NBA player back then. And that doesn't diminish the accomplishments of the NBA players. It's just like similar to corporations. These companies are just better at dealing with policy shocks, inflation, supply chain problems. So one of the things I took a look at, even the way that NBA players were paid back then, even if you inflation adjust their salaries from, let's say, the early 90s, they still make way more today. The mid-range player is making 2.5 times more than the mid-range player did in the early 90s. And then when you look at the superstars, it's almost laughable. So I have a table. It's not particularly gorgeous, but for argument's sake, Patrick Ewing in the 1990 to 1991 season made $4.25 million. If you put that in 2024 dollars, that's still $10 million a year. I think he would probably be significantly more highly paid. Hot Rod Williams made $3 million and change. That would be about $9 million today. Isaiah Thomas would have been making $6 million in 2024 dollars. Michael Jordan is a really great example. He was $2.5 million in the 1990-91 season. That would be about $6 million today. So it's the same sport. The sport has gotten bigger, more profitable. They make more money on luxury boxes, merchandising, streaming, a lot of things that didn't really exist to the extent they do today. I look at the stock market the same way. All of these S&P 500 companies are significantly more global than they were 30 years ago. So I think that similarity is important that you point out. Like, hey, what if we were to top in February and it was because this exogenous shock that screwed up the market? But my counterpoint would just be like, I bet you the companies of 2025 are going to weather that better than the companies of 2024. And so far, that seems to be what's playing out, at least when you look at the results they reported in Q2 and the guidance they laid out. You guys have a take on that? What do you think?
I'll take a shot, but I'm sure Jessica does as well. I mean, you got to remember, like, corporate earnings aren't guaranteed the way, salaries in sports are. So, where earnings are going to be variable. And the thing I'd also say is that investor sentiment is always going to be the same. People will always fear a recession the minute they see a reason to do so. So the effect on the market is going to be a lot more similar to 94 to today, simply because the investors say, oh, crap, this could be a recession coming really fast. The Fed's going too fast. The president's going too fast with tariffs. And that net psychological effect's always going to be about the same. Whenever we see fear of recession, we see the VIX go up, we see stocks go down, and that's rational because in a recession, corporate earnings go down. They might be down less than the average recession, but they're still going to be down, and markets don't know where the bottom is. So from a psychological impact, these shocks, I think, will always have about the same impact. And also, as Jessica, I think, alluded to, you have to fix the reason for the shock in order to get stocks to reverse.
Right. So we sort of fixed it. Not all the way, but it was enough. And I guess that's a testament to people just believing, hey, this will get all the way fixed eventually. Let's place our bets today.
Yeah, as much as Trump gets aggressive, he's shown that when the market, when the VIX hits a 52, a 4 standard deviation level, he will soften his policy stance, and that was enough to, like you said, create an inflection point where stocks could start rallying again.
Okay, I want to move on to technology stocks because obviously the most important area of the market, and we talk about it a lot, but you guys have an interesting way of thinking about breaking down the current valuation of technology stocks as an example, but how people are currently valuing these companies and what goes into that calculation. Who wants to take this one?
Yeah, that one's mine. So there's a table we've got which shows a calculation, which I'll walk through right now. And it's something that any investor can do at home. It's very simple to do and I think very telling and a very nice way to understand how much of a stock's value is based on their current earnings power versus the future. So the way you do it is you go find the 2025 earnings estimate for a company. So for example, for NVIDIA, it's $4.28. That's the current estimate. Then you assume that that's what the company can earn forever. And so you discount it by 10%. That's the way you calculate a perpetuity value or how much this thing is worth if you get paid that number forever. And that works out to be $42.80. It's just 428 divided by 0.1. That is the value of what NVIDIA is worth today. If NVIDIA does nothing more than make its current number today forever, it's worth $42.80 a share. However, the stock is trading for $141, $142. So the vast majority, close to $100 of its value, is coming from the market expecting more earnings growth in the future. And in this case, quite a bit, because what you get when you do that math is that 70%, 70% of NVIDIA's value is based on earnings growth that it doesn't have yet, earnings it doesn't have yet.
And we're counting on from the future.
Yes. So if you do the same math for every other big tech company, Microsoft, Apple, and so forth, what you find is the average of all of them is 68%. 68% of the value of that company is based on the future. That's very different from the S&P because the S&P trades for 56% future value. And if you X out big tech, it's only 35%. So the market is saying, hey, if you're an S&P 493 company, we'll give you a 30% premium to your current earnings as far as imputing future value. That seems fair. Very good companies, Josh, as you alluded to, very strong companies, good management, probably the best they've ever been. But 35% is the most we're going to pay. However, if you're one of the big seven, we're going to pay you an average of 68% premium. And if you look at Tesla, which is really the standout, 94% of its value is driven by earnings it hasn't made yet, and earnings power it has not shown that it can make yet. So basically the entire thing. Palantir, by the way, is the same way. Palantir trades for 95% future value. Not to say if it's right or wrong, but really the bottom line here is the market is saying Gen AI, all these new technologies that we've talked about, all the things that are really exciting in the market, the companies that will enjoy those gains are the big seven because the rest of the S&P trades for a very modest multiple improvement versus what it can earn today, where these tech companies, the majority, 68% of their value is driven by things that haven't happened yet.
Yet nobody who's invested in Palantir or Tesla owns those stocks as a function of what those companies' core businesses are circa the last 3 years. It almost doesn't matter. Like the people, if you talk to shareholders of Tesla, they're not interested in monthly auto deliveries because they think they own a robotics play, arguably the most dominant. And when you talk to people who are long Palantir, it's not relevant to them how much the company earned or didn't earn last year because they're thinking about AI contracts going forward as far as the eye can see. And Palantir's technological advantages in those areas where they're headed, not where they're already entrenched, which is arguably already pretty impressive. So so that makes sense that when you dissect these companies and you think about how much of this valuation is based on earnings the company hasn't even proven it can earn yet, well, that's the bet that these people are making. And they'll either win or lose that bet, but that makes a lot of sense to me intuitively versus a Microsoft. You talk to that shareholder base, of course they're excited about future technology, but they're also equally enamored of the company as it currently exists and its current cash flows. And that's a big psychological shift you guys are saying versus the rest of the S&P 500 ex big tech, where we're not really giving these companies that much credit for earnings they haven't earned yet. Does that make sense to you guys, though, just if you think about this through the lens of disruptability and the disruptors versus the potentially disrupted? Or are we overestimating the future potential of the disruptors and underestimating the indisruptibility of the incumbents? What do you guys think about that paradigm?
Yeah, I mean, the market's saying very strongly that only these companies or companies like them, because by the way, the next 7 big tech names or slightly smaller tech names have exactly the same numbers as what I'm showing you on the screen. They all look like this as well. So the next 7, the Netflix of the world, the Palanters of the world, Salesforce, they all have the same kind of, they look exactly like this. So the market's very clearly saying, hey, look, we've learned our lesson. Over the last 30 years, the biggest winners have been technology-enabled disruptors. That's what these companies are. That's why we have to bet on them. The only other kind of big winner has been the very handful of companies with super strong management teams that have been able to grow consistently over a long period of time. Walmart, Costco, P&G, even ExxonMobil is on the list of big 30-year winners because they have great management. So it's really hard to find great management, and it's hard to know that they're going to stay great, but technology is a little bit easier because you have Moore's Law as a tailwind behind all of this. So it's easier to bet on tech, which is why the multiples are the way they are.
So I wanted to share some stuff with you guys from this past earnings season because I think it's so illustrative of why people are willing to make that bet and pay up for future tech earnings to the extent that they are. So in the Q1 reports that we've just gotten, this is via FactSet, earnings from the Mag 7 companies exceeded estimates by 14.9%. For all S&P 500 companies, earnings exceeded but only by 8%. So in a season where the upside surprise was pretty good, among the 7 largest companies, it was even better. And this is obviously a recurring theme in why these stocks got to the size that they've gotten to. The Mag 7's actual earnings grew 27.7% year over year. Big surprise. Google, NVIDIA, Amazon were among the top 5 contributors to earnings growth for the whole market. Sean put together for me the top 2 performers year to date, stock price, Meta and Microsoft. One is up 19%, one is up 12%. The bottom 2 are Tesla, negative 27, and Apple down 19. So you have dispersion in share price even among the top 7, even though as a group, they're still shocking us to the upside. And as a group, they're still far out. I know it's only 7 stocks, so we're not averaging but just thematically for the investor class, they keep making this bet. The bet keeps paying out. Last thing, 6 out of 7 of the Mag 7 companies had a positive earnings per share surprise. 78% of the S&P 500 components. So the whole market had a good earnings season, better than most of us thought would be possible. And even in that climate, these 7 names as a group, with one exception, were able to continue to surprise to the upside. And that, I think that really explains beyond the imagination of like the robots driving us to work, et cetera, just like from an earnings standpoint, it explains why people keep making that bet and why that bet keeps paying out. What do you think about that concept?
Yeah, it's true. I mean, the long term for investors is ultimately, a bunch of quarters, right? The long term is 10 quarters, 20 quarters, 30 quarters, but we measure them by quarters. And if you get a good quarter, your confidence in the long term begins to go up a little bit. And let's just remember, like, even though these are just 7 companies, they're 32% of the S&P. They're a dominant part. They're dominant for a reason. And they're going to continue to be, or something new comes along. Maybe OpenAI goes public in a couple of years and becomes, a multi-trillion-dollar company. So whatever technology disruptor exists in the U.S. market and is U.S. listed is going to end up at the top of the S&P league table. It's just going to be that way for the rest of our lives. That's going to be
last
the
thing I want. Oh, Jessica, please go ahead.
I was just going to say markets have over the long run, have a difficult time discounting innovative disruption. And that's why these types of companies outperform over time.
I wanted to ask you, is there an potential upside catalyst for the overall S&P 500 as we see more companies in the index adopt the strategies and tactics of the Big 7 and attempt to look more like them in their revenue models, in their client acquisition strategies? In other words, do the Mag 7 serve as some sort of a beacon that the 493 could ultimately pattern their businesses after and ultimately drag up the earnings growth of the overall? Or is that asking too much of companies that are just not in the tech sector themselves?
I'll take a stab at it. I did this math that I just showed you, but for Ford and GM. So GM's supposed to earn $9 a share this year. So its present value is $90. Stock trades $45. So it trades at 50% discount to what it currently earns. And the reason these companies are as strong as they are is primarily because their business models are very asset light. They don't own a lot of assets. They own intellectual capital, and they have somebody else produce the assets. And it's very hard for a company, particularly in the current environment now, to shape its capital structure or its capital intensity dramatically to lighten it up. You just can't be an outsourcer the way these companies ended up being massive outsourcers. NVIDIA doesn't make anything, right? Apple doesn't make anything. It's very hard to get to that business model. It's probably harder now than it was 10 years ago. So it's going to be
hard to do it in the reverse order, where you say, we make all this stuff and we're going to give it to someone else to make. It can be done, but it's really hard to do.
Hey, Apple did it. Like there's a great book now I'm reading called Apple in China that gives the whole history of how Apple ended up being a Chinese-made set of products. And it started with Apple actually owning all its own facilities. And Steve Jobs loved to manufacture. And it took him a long time to appreciate that outsourcing was a better approach. But he eventually got there, and that's how the company got here to where it is today.
Right. Nobody wants to publicly announce that their strategy in the Trump era is to outsource more. That's not going to be particularly popular. All right, guys, I want to thank you so much for your time today. And I want to make sure that the viewers know they can check the link below to find your YouTube channel. Nick and Jessica are publishing their insights on YouTube twice a week. How often are you guys going live?
At least once a week.
Publishing?
We got one coming out this week, yeah.
All right. Very cool. Make sure you follow the DataTrek channel if you love hearing from Nick and Jessica as much as I do. It's a really easy way. Also go to DataTrekResearch.com and find out how you can become a client. Thanks so much for watching. Thank you guys for listening. We'll talk to you soon.
Thank you.
Thank you.